Welcome to The Big Picture, your no BS market review of crypto markets. Ever since the first massive advance in 2013, cryptocurrency enthusiasts have adopted several narratives to justify holding their favorite coins. In particular, Bitcoin is a store of value. It's a hedge against inflation. The list goes on and on. Unfortunately, being biased leaves you susceptible to loss. Today, I'm going to dispel a few of these popular narratives, then take a closer look at the technical landscape surrounding the May collapse, and what signs you should look for when determining whether it's time to dip your toe back into the shark-infested waters and buy, or wait to avoid the rug pull and being steamrolled. Before I do that, I need to remind you that Cryptobux and I am an educator, not a licensed investment advisor, and that you should never act upon any of my opinions. Everything I present is meant to help you do your own research and understand how I go about making investment decisions for myself. Nothing more. I highly recommend that you speak to your financial advisor before making any investment decisions. Please pause the video and familiarize yourself with my important disclosure notice. You can also read that and other information about risk at cryptobux.io. If this is your first time watching, my name is Mike Sinibaldi, and Cryptobux provides all the pertinent news, independent analysis, research, and blockchain data that you need to understand the greatest disruptive transformational technology since the internet. If this is what you're looking for, smash the subscribe to the channel button and turn on the notification bell so you don't miss any of my content. You can also get daily updates and charts by subscribing to my free member community at cryptobux.ecofin.com/signup. I'll post a link in the description below. Now let's get right into the June market recap. Earlier I said that enthusiasts use several narratives to justify holding Bitcoin. I'm here today to dispel these dangerous narratives, an unpopular opinion for sure. Myth number one, is Bitcoin a store of value? In my opinion, no, it is not, and here's why. A store of value is fiat currency. It might not have the same purchasing power year to year, but when you ask for what you deposited in a bank, you get back the same value unless you reside in a country with negative interest rates. Bitcoin and crypto moves like all other risk assets. It's not a fixed value, and prices fluctuate according to supply and demand. Myth number two, Bitcoin is a hedge against inflation. Well, partially. Let me explain. In a research paper dating back to August 1989 entitled, "Does Dollar Depreciation Cause Inflation?" the main conclusion was that inflation is a monetary phenomenon. An increase in money supply ultimately leads to inflation that usually occurs at the same time that the US dollar falls in forex markets. Moreover, the inflationary effect of a US dollar decline in value are subject to invalid reasoning due to the transitory nature of relative price shocks. While a depreciating dollar may cause an increase in some imported goods, these relative price increases aren't inflationary, nor do they promote an upward move in wages and prices in the future. Is there more recent research to show otherwise? I haven't done that deep dive. But we all know that the word inflation is transitory, is the Fed's narrative as of their most recent FOMC decision. Now let's take a look at money supply or money stock and its relationship to Bitcoin. In theory, Bitcoin should rise as money stock rises if it's an inflation hedge. We find M2 increases from May 2005 to January 2009, declined from January 2009 to March 2010, rose from March 2010 to January 2012, declined from January 2012 to November 2018, rose from November 2018 to February 2021, and is now currently declining. In comparison, beginning with December 2013 to March 2017, Bitcoin was relatively flat. From March 2017 to December 2017, it rose. Declined from December 2017 to December 2018. Rose from December 2018 to April 2021, and is now declining. In conclusion, while there appears to be a correlation between late 2018 to present, it's dangerous to be investing on this data alone. Feel free to look at the correlations since 2009 on your own. With that said, it's clear to me that if you are of the opinion that Bitcoin is a true inflation hedge and influenced by M2, then you don't want to see M2 declining. Let's move to the macro charts and some intermarket relationships and where I think the crypto markets may be headed. The first chart is of inflation, represented by the 5-year break-even inflation rate. The expectation of higher inflation has been on the rise since March 2020, and the current expectation is 2.49%. The next chart I'd like to look at is the yield curve, specifically the 10-2 spread. As the percentage is steepening, it signifies higher interest rates in the future. Here I'm watching for a retest of the open gap. And here's a chart of the 10-year T-note, ticker symbol TNX. Like other inflation metrics, it's been trending higher, reflecting the possibility of higher interest rates in the future as the Fed may be forced to keep inflation in check. We do, however, have an interesting development as support has been broken. It's worth watching. Next, the chart of gold. Gold has a negative correlation to interest rates, meaning it goes up when interest rates drop. Another way to look at this is through the lens of inflation versus gold. In periods of inflation, gold rises, and during deflationary phases, gold declines. The current regime appears to be inflationary. Next, copper. Copper is a key industrial metal and a leading indicator of the economy. It helps in forecasting the direction of interest rates and thus inflation. Copper futures have rallied since March 2020, reflecting economic recovery, higher growth expectations, and a general rise in interest rates and inflationary pressure. One of my favorite indicators for risk on, risk off, and recession forecasting is the copper to gold ratio. During risk off regimes, the price of copper falls, gold rises, and the 10-year note declines. Currently, we see the opposite, a strong rise in copper-gold ratio. This represents a risk-on environment. So here's the $100,000 question I have for you. If U.S. equity indices, commodities, and interest rates are rising, reflecting an appetite for risk assets, then why did Bitcoin and cryptocurrency markets decline approximately 50% of its value, considering it's a risk-on asset? While you think about the fundamental or regulatory answers to that question, what insights, if any, can we gain from the individual charts of each coin? Before looking at those, I need to explain what I look at and the model I use to help me forecast both direction and trend. Direction and trend are two different terms. They are not the same. And your own due diligence will differ from mine because your time frame may have a different duration. Regardless, the model I use is Elliott wave, and it is fractal, meaning price movement on all time frames follows the model. In simple terms, in a trending market, price moves in 5 waves. 3 thrust moves, waves 1, 3, and 5, and 2 counter trend moves, waves 2 and 4. Wave 3 often subdivides into 5 waves. The counter-trend moves, waves 2 and 4, subdivide in 3 waves. Let's see what the model looks like using a real 30-minute chart of Coinbase and Compound. We say that the trend is up upon seeing a 5-wave advance and the current direction is down. Another example is Compound. Look at the thrust higher. This is one of the better charts out there right now. Can you see it may have completed 3 waves up, and we'd be looking for a pullback in wave 4 and then another advance for wave 5? Let's see if we can build upon these principles. Here, the chart of Bitcoin. In general, where Bitcoin goes, the rest follow. At daily chart level, we see that we have 3 waves up. While the trend is up, direction is down in wave 4. A typical terminus point of wave 4 is the 38.2 retracement of wave 3. And while most others out there have called the bottom, there can be no assurance of such. My opinion is that I don't really see any thrust off the lows, and it's hard to fully embrace that wave 4 has completed and that I should look for a directional change and the resumption of trend higher. It is possible that wave 4 continues in a more sideways direction, as you'll see in the chart of Ethereum. Ethereum is tracing out a similar 5-wave advance. I'd be remiss not to consider that the chart looks a bit more constructive off the lows than Bitcoin, and I might be inclined to think that Ethereum's 4th wave is unfolding in a more sideways affair, as evident that it has made a shallower pullback only to the 23.6% retracement of wave 3, whereas Bitcoin actually made its low beyond its 23.6% level. To summarize, I'm of the opinion that the majority of cryptocurrencies have price action that is consistent with that of Bitcoin and Ethereum. Both are directionally lower in what I believe to be an Elliott fourth wave decline that should resolve higher once complete. I'd encourage you to look at the charts of the coins you hold to see how they compare to the Elliott wave model for price progression and to Bitcoin or Ethereum. Let's leave it there for this month's big picture, and best of trading.